Hey guys, welcome to another video. In this video, I wanted to take a look at the 3 worst trades or investments, I guess, that I made for this year. And what we're going to do is we're going to look at them really quickly, and we're going to see what I did wrong and see what you guys can learn from it, so that way you don't make the same mistakes in your investing journey. So we're going to go in order of the magnitude of the mistake. So first one here is Beyond Meat. So I like to just throw it out there that 2 out of 3 of these involved options. So just be very careful when you're playing with options. A lot that can go wrong. There's a lot that could go right quickly, but there's also a lot that could go wrong. So let's jump into the Beyond Meat mistake. So I was selling puts. So selling puts basically means that you're betting that the stock will be above the strike price at the time of expiration. You get a credit, you get paid up front. So if you sell a put for $7.20, so let's just look at this example actually. So I sold a put that ends, the expiration date was July 2nd for the strike price of $150. So basically I was betting that Beyond Meat would be over $150 a share at $7.20. Once I placed that trade, so if we look back, here are the 2 dates, right? So I placed the trade on June 28th, so I was doing weekly, selling weekly puts. And so on 6/28, this other line is the date of the expiration. So at the time of placing this trade, the stock was about around 154 or something like that, and I figured that it would continue to rise. Now this is before I was looking at any kind of indicators. I was basically just going off fundamentals. I didn't really understand indicators. I didn't understand MACD, RSI. Had I done that, if you look, let me trace down here, we can see that it's curling up. So it still would have kind of made sense. The momentum was moving upwards, so it didn't seem like a bad trade, but it ended up being terrible. So I got assigned the shares, and then usually what would happen is if you got assigned those shares, you could then sell weekly calls against that. And you would do that if you want to keep the 100 shares. You just continue to do that. You'd set your strike price higher than you think it's going to go. Or in my case, I would set it at the 150 level, so that way on the if the stock goes over 150, I would sell it for a profit, and if it stays under 150, I would just continue to sell weekly calls against that. And you want, in a perfect world, for it to stay around the same level. That way you keep your premiums high. That's maybe something to talk about in another video, but in this instance, the stocks continue to fall, and variant news and inflation happened, and the stock has continued to drop. So at this point, I've lost about 56% of the value of my position. And what I'm doing for this stock is I sold long-term weekly calls. So we're talking 2024. So it is a long ways away, but if the stock moves in the direction that we want it to, we would be collecting money as we go. I'm not exactly sure what I plan to do with this stock. I think what I might do is wait for it to start recovering, because it is so low. If you look on the RSI, it's just been devastated. So maybe in the first quarter of next year, once it starts to regain some of its levels and it gets back to a better price, I might sell out at that point, take the losses, and just move on to the next one. So that's Beyond Meat. The lesson to learn from this is if you're selling weekly puts, make sure that you're setting a price that you feel confident about. Make sure that you're looking at the MACD and the RSI, and it looks like it's in a favorable position. And give yourself enough room. If I could go back, I wouldn't have put the 150 because it was already trading around that 150 level. So I'm not leaving myself much room for it to drop. We want to look at support levels too. So maybe what I could have done is I could have picked a 130 level, right? This looks like a very for support. You wouldn't be making less money, but it would be safer. Had I done that, if we go over, I wouldn't have been assigned the shares, right? The price would have still stayed above that 135 or whatever I would have picked, right? So you'd be making a little bit less money, but it would be safer. So that's one instance. So beyond meat, lesson learned. Next one is a little bit of a different story. This one is Dogecoin. Was pumping, and if you see here, this blue line is when I bought. So I had been putting money into Doge for a while now, even when it was back over here, and I just continued to dollar cost average. However, then things started to really pick up, became very popular. There's a lot of fear missing out, especially on my part. There's a lot of hype. Everyone was talking about Doge to the moon, and I just threw a large sum into Doge, and it was going up at the time. And unfortunately, I bought at the top. So if you look here, again, this is before I was really looking at indicators. This is a more clear-cut case, right? So if you're looking at candlesticks, you see that it's on a downtrend at the time that I bought it on May 9th. If you look at the MACD, it's already dropping. If you look at the RSI, it's starting to move downwards. So, and also, if I was looking at candlesticks, it's pretty easy to see that maybe now is not a great time to buy the stock. It just run up so massively, and it was already starting to fall. So, what you can take away from this is the fear of missing out. Don't fall into it. Look at charts, look at indicators, and don't buy because other people are buying at that same time. So that's Doge. Now, the worst trades that I've made of the year have been in two accounts and for workhorse stock. So I know a lot of people are holding the bag on workhorse stock. In this instance, I made two trades. Again, I was selling weekly puts, and I was picking strike prices very close to the actual price of the stock at the time, and there was a lot of hype around this company at the time. If you look back, even I think it started probably around here or so, maybe further back, maybe back here. They start talking about the U.S. Postal Service. So Workhorse makes electric last mile delivery vans. They're talking about a major contract with the U.S. Postal Service. It seemed like they were locked. Everyone was figuring that they would get it, and the stock just continued to rise up, and it just got to insane levels. Again, this is before I was looking at indicators. So I was just basically going off fundamentals, and let's just look at it real quick. So on February 8th, I sold a weekly put, that would expire on 2/12, February 12th, for a strike price of 38. So at the time, the stock was trading around 39. So again, not leaving myself any room, especially if it's run up. If you look on the MACD, it was already going down. RSI was already going down. There was no level of support until maybe, let's say, around 29. So I didn't give myself any room for any kind of drop. And it was announced that the Oshkosh actually won the contract. And so Workhorse did not win. And obviously people dumped the stock. Huge drop off. And I got caught up in it. And then, only to double down in another account, the premiums for these were so lucrative that I was selling weekly puts in multiple accounts. And if you go right, like I said, if you go close to that actual trading strike price, you make a bigger premium. So I had been doing that the whole way up ever since the contract was being talked about, and the stock continued to go up. I continued to make nice weekly income, so I didn't think anything of it. But so again, in the second account here, I sold on February 23rd. I sold a March 1st strike price of 31 cash secured put, and that was really part of the major drop. So at the time that I sold it, it was probably I don't remember, somewhere around here maybe. Somewhere around this level, right? 31 or something. And and I sold at 31, and that's when it absolutely tanked. It dropped all the way down to, let's say, $15, so half. So what happens at that point is you get assigned the shares. So I mean, you're forced to buy 100 shares at that $31 a share strike price. So automatically, as soon as you're assigned, if it's that $15, you're basically lost half the value of that stock. My plan for Workhorse is the company seems to be dead as of now. If you look later in the chart, there's not a lot of movement. What I might do is at the end of the year, I might take losses on it and then just roll that into a more investable stock. I think long-term Workhorse could be good, but that's really long-term. So I might just take the losses this year. But anyway, guys, so those are my 3 worst trades, and hopefully you guys took away something from this. Hopefully I prevented you from making the same mistakes in the future. If you appreciate any of this, please leave me a like, subscribe, and I'll see you guys on the next one.